Hey, hi everyone. I know people are slowly trickling in. Thank you for joining us on a Saturday morning on, I hope, exciting enough topic for fundraising 101 for interactive media and gaming startup. So, welcome to the round three of the B2B Forum's pre-event online bootcamp for GAFX. As most of you know, this is a build-up for the B2B event that's happening from 27th of Feb to the 1st of March in Bangalore at the GAFX. If you haven't registered yet, then Akhil will send the link and please do register for the event to meet investors, buyers, and fellow sellers from across the AVGC XR industry during the event in person. So today we are glad to have Aditya Deshpande, who is conducting today's session on fundraising. Uh, Interesting, important, and I hope exciting for a few who want to figure out the science, the math, and the showmanship on how to help pitch your right idea to firms like Lumikai. I'm so happy, Aditya, just to let you know, when Saloni and team launched Lumikai, that after many, many years, there was a focused interactive media and gaming fund for this industry. Whereas earlier, this used to be a very small portfolio across the major funds who had divided mindsets on how to look at this industry, which is divided in, again, different focus areas: esports, RMG, free to play, and different mediums to be there. Aditya is a senior investment associate at Lumikai, specializing in venture capital, deal sourcing, and investment strategy. He leads Lumikai's State of India Interactive Media and Gaming Report and has prior experience in private equity at HDFC. Uh, Aditya has lots of credentials in education, so I'm just going to let Aditya speak more about himself. But he holds a master's from financial economics from uh, Erasmus University in Rotterdam, I guess, and from bachelor's of economics in Namma Bangalore from Christ University. So passionate gamer. So by the way, we are having the national championship Counter Strike 2 in case you want to come and compete at GAFX, Aditya. So please have an exciting session ahead. And so let's get started. Aditya, it's all yours, the session.
Awesome. Thanks a lot, Chan. Thanks for the very, very kind words. Let's just dive right in. I'm going to really quickly share my screen. Let me know, like, visible, all good. Can you hear me all right? Awesome. Thanks, Chan. Thanks, Akil, for this opportunity to interact with folks and maybe shed some light from my side of the table on how a venture capitalist looks at startups, looks at fundraising, looks at especially within interactive media and gaming, looks at fundraising, right? My intention with this talk, of course, is to give you a little bit of insight into how as a VC, how the VC business operates, therefore how a VC thinks, and therefore how you should go about approaching a VC, what are must-haves, what are things that you shouldn't do, and also then give you some nuance into how all of that bakes in from a interactive media and gaming standpoint, right? Just to kick off, Lumikai, of course, we're a interactive media and gaming VC. Just set some context. We do early stage investments, so pre-seed, seed, pre-series A. We've been around since 2020. In that time, we've seen now over close to 2,500 startups in the ecosystem. We've evaluated 2,500 startups. We have 16 portfolio companies. Our check sizes range from $500,000 to $1.5 million. So that's kind of the early stage. We're a team of 8 people spread between Bangalore and Delhi. Myself, I'm in Delhi NCR. Uh, and of course, we invested in interactive media and gaming, and within that, there are 5 main buckets within which we invest. So one is content. So these are game studios, building either for Indian audiences or for global audiences. We've got platforms, so anywhere where two or more disparate audience bases come together to communicate or to interact. So it could be social platforms, community platforms, so on and so forth. The third is tool stack infrastructure. So anything that helps augment the industry, support the industry. These are usually B2B companies, but within the media and gaming purview. We also have a thesis around what we internally call systems of play. This is essentially we look at how interactivity, gamification, and all of those elements can apply to traditional industries like education, health, finance, to really disrupt them through gamification and interactivity. And lastly, we also look at frontier. So this is AI, AR, VR within this space. So some of our portfolio, of course, we've got here. We've got All Star Games, Bombay Play, Mayhem, that are all game studios. We've got businesses like Supernova, which is our systems of play, using gamification to upend education business. We've got Elo, which is a large platform. Framer and Autobus are B2B businesses within the space, right? So we've kind of got a very diverse portfolio. Uh, and a bit about me, of course, Chand has given you a quick brief. I'm a senior associate at Lumikai. I've been with the fund now for 5 years. Um, I do my biggest role has been investment, so sourcing, evaluation, due diligence, and actually deal execution. So I think of the 16 odd portfolio companies, I've been involved in 10 from end to end. So I've kind of seen that journey for a startup multiple times. I also support our portfolio on strategy, fundraising, hiring, growth, anything of that sort where I can help out. Portfolios I've largely looked at are game studios, platforms, and tech and infra businesses. So that's kind of where I've focused. And I lead all research initiatives at Lumikai. So the biggest one being a State of India Gaming and State of India Interactive reports that we do with Google and Deloitte every year. We've been doing that for 4 years. I've also been on the other side of the table, believe it or not. Yeah, VCs also have to raise money, much like startups have to. So I've been on the other side. I've seen rejection, I've done pitches, I've done follow-ups, I've done all of it, I've done cold emails, right? So I've kind of been on the other side of the equation as well, and done that for the fund. And I've been a gamer for over 20 years. I kind of played FIFA competitively back in 2020, 21. I was a top 50 player in India once upon a time. But I've given that life up to now invest. So I'm a passionate consumer of video games, but now I'm also a passionate investor in the gaming and interactive facets, right? So that's just some context on why I'm speaking to you in some sense, and what we do at Lumikai, and hopefully I can provide some perspective. Just to start, I'd like to sort of set some context, right? Having now interacted with, as we said, over 2,400 opportunities, interacted with founders of all kinds. One thing I've noticed is there is a misalignment in terms of the misalignment that comes between founders and VCs comes from the fact that most founders who are looking to fundraise don't understand how the VC business works, right? We also are running I'm from Bombay and we call it Dhanda, but we're also running a Dhanda in terms of making money. And there are very specific ways in which we make money, as a result of which there are very specific ways in which we analyze startups and decide whether or not to invest in them, right? So to give you some context, what does a venture capital fund do exactly, right? So what I do is I set up a fund. Maybe it's Cayman, maybe it's in India, maybe it's in India AIF, right? Depends on what my strategy is. But I set up a fund, which is essentially a limited liability company, essentially, right? Um, I go to investors, which could be large endowment funds like Harvard University as an endowment fund that invests. I go to large corporations have a strategic interest in what I'm doing. So in our case specifically, we're investing in gaming in India. So a lot of our investors are global gaming companies. So Krafton, Supercell, Garena, etc., who all have a vested interest in India, are sort of given us money. We go to family offices, so large industrial businesses who have a lot of money who want to invest. So we go to family offices, we go to individuals, HNIs, all of that, right? And we pool that money and put it in the VC fund, right? That is the pitching side of the business, which is what we do. My goal after that is my day to day essentially is to take that money that I've pooled together and invest it in startups, right? And I have a strategy around it. Like for us, it's a strategy of gaming and interactive media. There are funds who do only fintech. There are funds who do only late stage. Some funds will do only early stage. Some funds will only back certain kinds of founders, right? The strategy varies. In our case, it's gaming and interactive. So I take that money and I invest in gaming and interactive media companies, and that's essentially my portfolio. This is essentially my day to day, is finding companies, investing in them, and then managing that investee company to a point where now it's grown and I can get an exit. So in all of this, how do I as a VC fund make money? is I get an annual management fee from LPs, which kind of keeps the lights on, which I pay for my office, I pay for my staff. This is a 1 or 2% kind of fee I get annually. So if I'm a $10 million fund, I'm getting $200,000 a year essentially from my LPs to keep things running. Obviously, that's not how VCs create wealth. VCs create wealth through the second part of this equation, which is share of profits from sale of portfolio. So I don't make money when a portfolio makes revenue. I'm not making dividends, right? That's not why I'm in this game. My kind of value comes from the fact that when my portfolios become big enough, and when I sell my share in that portfolio, I can split that share of profit with my investor and me, right? And that share varies. It varies in terms of what the split is. It varies in terms of how it is split, when it is split. All of that matters. But the large wealth creation only happens at this second level, right? And this ties into kind of what VC economics are, right? And I'd like to walk you through an example, and all of this will kind of tie into how a VC evaluates a business, right? Trust me on that. So let's say we raise a $10 million fund, right? We've gone to LPs and we raise $10 million. I am going to do an average check size of 1 million across 10 companies, right? That's what my fund is going to do. Let's not talk about strategy or anything yet, but just 10 companies, $1 million checks. And my average stake in this business, in these businesses, is 10%, right? That's my fund. Um, and assume I am gunning for a 3x return. 3x is usually a good return for a venture capital fund, that puts you in a 20-21% kind of annual sort of rate of return that you're giving over a 6 year period. But 3x return is what I'm trying to get, right? So how does this math play out when I actually look to exit businesses? So we're just going through our assumptions again. I've got a 10 million fund, $1 million check size. I've got 10 portfolio, so 10 million's done, and I have 10% equity in each of these businesses, right? So essentially, to get a 3x return, I need to 3x the 10 million. So I need to exit my fund at 30 million is essentially what I need to make out of these investments. Um, there are two big factors at play when it comes to venture capital, which makes it an incredibly difficult business. First is mortality. So we run on a power law where essentially only all of my return is going to come from 10 to 20% of my businesses. All the others are going to die. So that's what we call a mortality rate. So 80% is actually a decent enough mortality rate. So I'm going to assume that. So essentially, out of my 10 startups, two have died. Right? Sorry, two have survived, eight have died, right? So I'm looking to generate all this return from two startups. The other thing is dilution. Of course, my startups, if I'm an early stage business, my startups are going to continue raising money to keep going. So they go from seed to Series A to Series B to Series C. In that process, you're actually issuing new shares to investors, as a result of which my pie in that broader share keeps reducing. So um, I won't. So if I've invested at, for 10% when I actually came in, I'm not going to leave at 10% because my that stake's going to get diluted down to 5%, right? So there are these two kind of negative aspects that sort of affect the economics of a business. So in sort of our case, we've got two active companies. I need to make $30 million out of them. So my average exit of my stake has to be 15 million. So I've got one company, I need to make 15 million. I've got a 5% stake. Therefore, the value of the company has to be 300 million, right? So if you think about it, I invested in that business at a 10 million valuation, right? One for 10%, therefore 10 million valuation. That company now has to go to 300 million, which means that 30x growth in that business for me to make 3x return, right? So as a result, VCs are not going, and this average valuation uplift, right, which is like, but these businesses on average need to grow 30x. That grows exponentially with fund size. So if I have $100 million fund, I'm going to need 100x, right? If I have a $500 million fund, that number keeps growing, the number keeps growing, right? So the larger the fund, the more pressure on them to kind of pick companies that will 100x at 150 times, 200x, right? Only then do they make money and are able to kind of return the fund back, right? So that drives a lot of VC thinking. A VC is looking, once when you pitch to a VC is thinking, oh, is this business going to be 100 times business, right? And not 100 times in revenue, but 100 times in value, right? Because I will generate value not from revenue, but I will generate value from when I actually sell my stake in the business. So is the company going to be valued at 100x and I want to actually exit the business, right? for which I need a willing buyer on the other side who's willing to put in that money. So a lot of this therefore drives what a VC is looking for, right? And I kind of put this as, are you a 100x business or is this a 100x business, right? So what is a VC looking for? And I'm going to talk about this from my perspective as an early stage fund. Early stage means we've backed two founders in a pitch deck. We've backed businesses or pre-revenue, pre-product. We've done all of that, right? So in that case, what am I looking for? Right? So of course, the biggest thing that we underwrite, you'll hear this word a lot with venture capitalists. Underwrite is just a fancy word to say, okay, what do we like? Right? Um, People have different VCs have different ways to evaluate a founding team. We've got a framework called 5C, so I'm going to rely on that. But the founding team at an early stage is the most important part of the VC's evaluation process, right? So what are the 5Cs that we look at? Look at competence, which is the most important. Is the founder good, great, excellent to build in this space, right? This is the most important thing. Now, how do I find data points to prove that? One is maybe I look at professional excellence, right? What was your previous background? Have you exhibited some extraordinary sort of achievement, or okay, you were a we have a company in our portfolio called Curious Bit, where the founder Ram was actually employee number 3 or 4 at Play Simple. And if you don't know, Play Simple was the largest exit in game, like realized exit in gaming at $500 million in India. And he was the one who actually built the team from ground up. He was the one who set their systems, who did game design, who pushed the game out. Eventually, was managing a P&L of $150 million, right? That is a great example of professional excellence. So for me to kind of say, okay, this guy is worth something and will build something, right? So professional excellence is one way to look at it. And this, I'm just giving you an example of gaming, but it could be anything else, right? Okay, we've got a company called Studio Sera in our portfolio that's building mid-core games based on Indian mythology. Both founders are, IIM grads or whatever that matters. But okay, cool. Okay, fine. You had the grit to go to an IIM and come out of it. But okay, one founder worked at Nvidia, worked on the PlayStation chip, right? So okay, that's a great data point that I have on this person. So either there's professional excellence. In the absence of that, right? Maybe you're a young founder who probably doesn't have the experience to be able to now show or showcase this sort of excellence in this domain. The other excellence could be execution excellence, like something of some other thing. Okay, you've got me a prototype that is amazing, right? So I have now a data point to show that okay, cool, you're great at executing. You know what you're doing, right? Or you've shipped a product with very limited resources. That's execution excellence, right? That's I know for a fact that you're competent in this space, right? So competence, number one. Number two, character. Character more so from the perspective of, I guess, integrity and honesty. I've had a lot of conversations with with founders who to create FOMO, which is fear of missing out, and VCs lie about, by the way, I've raised money from this person, that person, that obviously it doesn't turn out to be true, or you're lying about your metrics, or you're lying about etc. A bunch of different things that you could lie about. That is a major red flag for a VC. Like we'll pass upfront if we won't even take a deeper look at it, right? So just integrity, honesty matters a lot. A VC fund will also do reference checks on you. So we'll talk to people you worked with, talk to people in your team, just to get a sense of how you are as a leader, whether the claims you've made on your competence were actually true. So character matters a lot. Again, it'll depend from fund to fund how deep they go into this. Like we personally go a lot very 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 deep into this because we're an early stage fund taking a lot of risk, right? So that's that. And I think good judgment and character, right? Like do you treat your co-founder well? Like what's the relationship between you and your co-founder? Do you treat your teammates well? Like all of that also matters to build a sustainable kind of long-term business. So character is something we look at. Commitment is also important. Like this is a hard, long journey, probably 10, 12 years of really grinding, of going through ups and downs, more downs than ups. Actually, so are you in it for the long run? One thing a VC will look back at your background sometimes and go, hey, by the way, this person's moved around a lot, right? Spending 6 months in one company, then moving, then moving, then moving. which kind of gives some insight into, okay, how committed are you to like one particular cause, right? So that also is something that we look at. So um, how committed are you to building this business? There could be other data points like, okay, you've left your job and you've been working on this bootstrap for 6 months. That becomes a commitment. That's a positive sign towards commitment, right? So that's another point. Clarity in terms of, oh, sorry, clarity in terms of, do you know what you're building and what it's going to look like? Do you have some vision in mind? Because if as a founder, your vision is not clear, it's not going to permeate to the rest of the team. It's not going to flow down to the rest of the team. And therefore, as a company, you'll probably be a little disjointed. Um, right? So do you have clarity of where this is going to go? And are you able to articulate it? So in a pitch with me or any other venture capital fund, if I ask you, hey, where does this go in the next 5 years? Do you have some vision? Maybe that vision changes in 6 months, 8 months down the line because market realities change. That's fine. But at that point in time, do you have a clear vision or plan of where this is going to go? I think, do you also understand what are table stakes for the market, right? Like, do you know where the market is? Because I still hear, guys wanting to do Web3 in today's market, like trying an idea that was done 3 years ago and thousands of companies have failed at. Right. So just some understanding of, okay, where boss, where is the market at? What is the basic requirement to actually play in this market, which is what I mean by table stakes. If you look at free to play casual games today on mobile, the guys at King, the guys at guys doing Royal Match, Peak. All these games are looking like Pixar movies, right? Like that's the production quality. So I do you understand, like, okay, this is the bare minimum experience that a consumer wants today, and that's what I'm going to deliver. So that's another thing. I think clarity also comes in terms of, do you know what your milestones, KPIs, key metrics are, right? So if you're a free to play gaming business, do you know I need to track D1, D7? I know I need to track my CPI. I need to track my conversions, like whatever, right? Whatever business you are in, do you know what metrics are to be tracked? Um, and how does that change once I'm like grown? I'm an early stage company. What does it matter? What matters when I'm a late stage company? What matters? Just some clarity in terms of how that works out. Um, and lastly is curiosity, right? Curiosity in the sense of, um, are you abreast with latest trends? Like for example, with sort of the LLM world, right? You have new things coming up every not even 6 months, every 6 weeks there's something new. So are you keeping abreast with trends? And even out of not LLM, like user acquisition for free to play games, do you know? Okay, by the way, AppLovin performs better than Unity. And okay, Meta has this new change that makes it very difficult for me to do targeting. Just that being curious enough to kind of push the business forward really matter. And this is, this could be through reading, this could be through connecting with, like, there's so many experts now. And I'm talking about gaming, but so many experts globally that just give you 30 minutes of their time for free. And do you have that hustle to really figure out that where that goes? And I think just knowing competition, like for me personally, a big turn off point is when companies underestimate their competition or say, by the way, there's no competition. These guys don't know what they're doing. Which I think there has to be some acknowledgement of, by the way, this is my competition. This is what they do well. This is what I think they're faltering at. And also a bigger turn-off point is that you don't even know who your competition is, right? So if you come to a VC with a pitch and you say, by the way, there's no one else doing this, and the VC finds five other people doing this, it reflects really badly on you, right? So that's where curiosity comes in. Like, do I know who else is building this? Um, right? So that eventually matters. So that kind of forms a composite of a founding team. So when I'm just evaluating a founding team where there's no product, this is what I'm looking at. Like, can I get a check mark on all of these things here that'll give me comfort as an early stage. We should say, okay, this is the right team to back. The second thing is market dynamics. Obviously, this also is important to understand. Okay, great founding team, but crappy market. It's not a good thing, right? You need great founding team, but you need a decent market as well to operate in. So what are the market dynamics we look at? I think market size, people call it TAM, SOM, whatever that is, right? But just like, how big is the pie that you are targeting. So what matters there, one, does the pie exist? Like free to play casual games, yes, there's a big pie. I know like 30-35 billion dollars of revenue is mobile free to play casual. That's a big pie, right? Or is it a new market being created? So we've recently been looking at Roblox, and what sort of developers can build on Roblox. What is the potential market size? That's a market that obviously Roblox is a big enough company, so there's that they make that much amount of revenue. But the market of developers building on Roblox, that market is fairly new. So are you creating a market? And if you are creating a market, what are the early signs? So here I can look at, okay, Roblox, billion and a half in revenue, growing at this rate. They're saying I'm going to give 30% of revenues to developers. Or we've been looking at animation and VF using AI and animation and VFX. Look, large enough market, but not many players kind of doing the AI thing there, right? So all of that kind of matters in terms of, okay, is this market already big, or is it going to be big enough? And what's growing the market, and what are the drivers of that market? Is something that I will look into, and something that you should also, as a team that's reaching out to VCs, know the reality of the market that you're playing in. Competitive dynamics, as I kind of mentioned, does competition. I'll go out and do like a research and do like a comp landscape. By the way, there are like 10 companies doing this. Is the industry consolidated or fragmented? Consolidated means like, are there just like three big players who drive majority of revenue? Or is it fragmented? There's a lot of the small players. It's very open source. There's no real path to being a market leader, right? We just need to kind of figure that out. And what is the gap in the industry? Like, what are these guys not doing? What is their blind spot? What's preventing them from doing things? And therefore, can a new startup come in and actually disrupt that industry, which is kind of the art of disruption is what people call venture capital. Actually, it's the startups that do the disrupting. But that's it. Can you then disrupt a market, right? What also ends up mattering is just business moat. So what you're building, what is the defensibility of this business? What is it that you're doing differently? Is the added points, is the more technical? Is it the fact that you've got this crazy targeting engine internally that personalizes user experience, or you've got a personalized web store, or your store is personalized based on kind of player preferences? Is there a technical moat here? The bigger the technical moat, the less the chances of you being disrupted, right? So are you doing something that is really unique, very difficult for someone to replicate? Is it a product led? Your product is so good. Your product is the user experience is so delightful that no one else can come and disrupt it, right? Is it a sales led mode, like the way you monetize is different and no one else can do it? Is it data led, like I've got massive amounts of data that no one else has access to, which is, I think, if you're doing something in AI where you're training LLMs, open source LLMs to do something, data mode becomes very important, because the model everyone has access to, but data not everyone, right? So Framer, which is one of our businesses, has a massive data mode because they have access to this content repository of like 30,000 hours on which they train their models, which no one else has, which makes their models much better than everyone else's. Or is it distribution led? Like you figured out a way to do user acquisition that no one else knows. So you're just like out competing on CPI by like 50%, which is a lot of, like, if you look at, if you guys are into gaming, and look at free to play mobile games in Turkey, that's essentially what they do. Like there are guys who are churning out 2,800 creatives in a month, where like the big guys are doing just four, right? Big delta, but they figured out how to do that, right? So what about your business cannot be disrupted? Something that for you to also think about when you're kind of building this, right? What walls do I set up around my business today, that makes it very difficult for people to break in? Um, so business mode, I think, ends up mattering a lot. And then timing. Why is now the right time to build this business? Like, why wasn't 2 years ago the right time? Why isn't 2 years from now the right time? I think a lot of businesses today would not be possible 4 years ago if LLMs weren't around. But now you've got 4 years. LLMs were around 4 years. Let's say 10 years ago, right? Because LLMs weren't really evolved to a point where they could be used. That's a great example. So why is now the right time? What factors are currently prevailing in this market to make it sort of a good time for you to build this business, or for this sort of business to be built? Uh, And has this been tried before? And if it has been tried, like you look at AR/VR and look at AR/VR had kind of like two big peaks and then eventual trust, because obviously the form factor wasn't there yet. People's preferences weren't there yet. I think gaming in India, for example, right? We didn't have UPI once upon a time. We didn't have cheap data, so gaming never really took off in like the gaming 1.0 version of it. But gaming is taking off now. Interactive media is taking off now because of these reasons, right? Because now we've got infrastructure has improved, people's preferences have changed, people have a lot more disposable income. So it's worth thinking about. Or is this a business that 2 years from now will make sense? Because I need this much amount of development to happen by then. So timing matters a lot. And all of this tied up with what I spoke about the founders actually leads to this kind of big question that VCs want to answer, which goes back to my initial point of, are you a 100x business? So will this business grow exponentially? I'm not looking for linear growth. I'm looking for exponential growth. Um, Linear growth is more of private equity mindset of being safe and don't die. But I'm looking for moonshots. I'm looking for exponential growth. Is it going to business going to like grow in revenue 50 times, 100 times just on the back of my 500K check? The second question I like to ask is, how much capital does this business need in the long run, which affects my dilution. Like, are you going to need a lot of capital? Are you going to be on this treadmill to keep raising money every 12, 18 months? And do you have the ability to do it, right? So how much capital does the business need? And who are the downstream investors? Like, who invests in the Series A of this business? Who does the Series B? Is there appetite for a Series A or Series B for this type of investment? What is the exit opportunities, right? So this is all of this a VC will look at, but I also want to reiterate it's something that you, as someone who's kind of building out your business model, also building out and pitching to VCs, building out your pitch deck, all of that, these are things that you should think about, because this is what a VC is thinking about, and these are questions that will come up when they kind of evaluating the business. And I think I've got a third part here, and this is more specific to gaming and interactive, and of course, probably doesn't apply. And I've said varies basis stage, but doesn't apply to everyone. If you're just two founders and a pitch deck, very no product, obviously you don't have metrics or KPIs, but you could be a business that has a product running for 1 year. So do you have metrics and KPIs for that? You have an alpha? Do you have a beta? Run limited test, and do you have metrics and KPIs for that, right? So what are the metrics and KPIs I would look at as a gaming or interactive media investor. Um, and again, there's nuances to this. There are certain things that wouldn't apply from a free to play mindset to a B2B business. Of course, it really, really sort of depends. But I put it into sort of five main buckets. One is sort of acquisition. So how many people are you acquiring daily? What are your total downloads? Are they growing? How much is organic versus inorganic? How much is organic traffic through referrals, through people just finding about it through SEO, or how much is paid performance marketing, right? And how does that tie into your strategy? Because hyper casual, for example, everyone does performance marketing. Like, I don't expect a lot of organic growth there. So organic versus inorganic. I think CPI is really important. How much are you spending to get your user? Total registration, sort of installer registration, all of that. If you're a B2B company, this would change. It would change into what are your total leads you're generating in a month? What is the conversion to qualified leads? What is the conversion then to a POC, right? So all of that sort of matters at the acquisition level. Then I look at engagement. This is more so for consumer businesses, daily actives, monthly actives, weekly actives. This depends on is it a daily use case? Is it a weekly use case? Is it a monthly use case? That's something you should absolutely clarify to investors, saying that, okay, my DAO is low, but look at my weekly actives, because this is a weekly use case, right? So people can come in at any point in the week, which means my Tuesday DAO will be lower than my Wednesday DAO, but all of that gets caught up in my weekly active, because I think it's a weekly use case. I think fantasy, for example, is a weekly use case, because games don't happen every day, so people are probably not logged in every day. So weekly actives makes a lot more sense. I think and a VC worth their salt should be able to tell the difference there, right? And know what metrics to track. Daily time spent, again, very important. Again, in the context of uh, is this like, is it a mid-core game, then yes, I'd expect people to spend 40, 45 minutes per session in the day. If it's a mid-core game if it's a PvP game where one session is only will take you 25-30 minutes, but people are coming in for 5 minutes, there's something off. There's something that makes sense to me. Like people are not playing the game. What are the number of sessions? What are the events per session? That's up to you to track. But like if you want people, I'll give you a great example. So Monopoly Go, Coin Master, and all of these guys who kind of run these social casino games that have been tremendously successful. Monopoly Go does $1.5 billion a year now, and their North Star metric essentially is number of spins per DAO, and that's what they track. So is there like and that leads to everything else in that flywheel of then eventually people retaining and eventually people monetizing. So what is that one thing? What is that one play pattern in your game or one event in your app? For TikTok, it could be like how many times are people swiping. For something like a Tinder, it could be how many matches are happening, right? But you need to as a founder figure out, okay, this is the main metric that I track on a daily basis to know that okay, my user is actually enjoying the experience. Retention is very important for consumer businesses. I think also for SaaS businesses. But if it's a daily use case, track daily retention. If it's a weekly use case, track weekly retention. For monthly, track monthly. Um, Also, be very clear in what sort of retention you're tracking. We've seen businesses that present, um, so your retention has to be how many people were acquired in that particular cohort versus how many people of that cohort came back. If it's D1 the next day, or if it's week one the next week, um, it shouldn't be day one or after, week one or after, right? That becomes rolling retention, which kind of is not the right way to look at things, at least for us. So be very clear in what sort of retention you're presenting, how it's been calculated, where you're getting that data from. Is it Firebase? Is it Google Analytics? Whatever it is, right? You should think that should be clarified there. I think for subscription businesses, what is your net revenue retention? Like how many people are coming back and making repeat purchases? Um, that ends up mattering a lot. And this also subscription business also then applies to B2B SaaS and so on and so forth, right? Monetization, of course, right? For consumer specific, gaming specific, interactive media specific, what is your conversion to paying users? Do you know what the benchmark is like? Now, people come to me and say, by the way, I've got this free to play game and my conversion to paying, I want to hit is 20%. No business, no free to play gaming business in this world has hit a 20% conversion ratio, right? Usually it's the 0.5 to 2%, right? So that's way off. And it goes back to the point on like clarity and curiosity. Do you know what the market benchmark is, right? So conversion to paying users, knowing what that is, your CAC. So essentially your CPI divided by conversion percentage. So what is the price you're paying for someone who's actually paying in your game? What is the ARPU for ad-led models? What is the ARPDAU? And what is your LTV, right? Like if a user is staying for 7 days, what is the if used for 7 days to which a user lapse, my average user is how much LTV are they contributing, right? If it's an ad model, or if I'm a subscription business, I know that my user stays on for 12 months. So in that 12 months, how much do I get out of that user, right? If it's 100 rupees a month, staying over 12 months, I get 1,200 rupees out of that user. So what is the cost at which I should acquire that user, right? For me to make sense, which is then your LTV to CAC ratio, which is something that guys will also look at, right? And then then there's certain things around P&L that I look at, like what's your monthly cash burn? Like if um, you have crazy cash burn because you've got a very fancy office that you probably don't need, like something that I question. Is the founder taking an inordinately large amount of salary when he owns equity in the business? Like you own 60% of the business, that's what you're in for, then why you're taking a large salary? What are key cost heads? What is your gross margin, EBITDA, all of that kind of matters. But again, this will vary basis stage, this will vary basis where you are in the business, this will vary basis what sort of business you're building, right? So, metrics and KPIs is something that I look at as well. I think moving on to the fundraising process itself, right? And to kick off, I want to tell you about some sanity checks before you fundraise. And this is just my perspective basis conversations I've had with people who said, by the way, I don't think I was ready to raise VC money, or maybe I jumped into that process really quickly. I didn't know what is to be done, what needs to be sorted, right? So a couple of things that this is not me speaking, but this is me having heard from other founders and what their regrets were that they didn't do before starting a fundraiser. One is, are you ready to raise VC money? Because as I explained, right, I'm raising money from other institutions, so I have a fiduciary responsibility. Essentially means that, listen, I need to be prudent with their capital and I need to give them a financial return. That's my responsibility. And because that's my responsibility, I, as an investor, will bring in a lot of rigor into that process, right? So if I'm an investor in you, there'll be a lot of oversight, monthly catch-ups, frequent reporting, audits, board meetings, all of that will kind of happen around it, right? If like there's um and if I'm a board of director, then I have kind of, if things go wrong, I have like criminal liability and all of that, right? So I become a VC is extremely vigilant with a good VC is extremely vigilant with their investments, right? So are you ready to deal with that is a question you need to ask yourself, right? Or are you happy being list? I've got three people, I own all of the business and I'm going to grow it on my own, which is also a very, very fair way to do it because Gameberry Labs, which is, I think, based in Bangalore, huge business, all bootstrap, never raised VC money. He owns all of that business. So if he sells that business today for 500, $600 million, he gets all of it, right? So that's another way to think about it. Do you really need the VC money? And if you do, are you prepared for what a VC brings with it, right? Also reaching out to okay, so you said, okay, I need VC money. Reaching out to the right VCs becomes important. Not all VCs are created equal. Know what a VC focuses on, right? Are they early stage? Are they growth stage funds? Like, is this a VC that only does Series B, Series C, Series D? Or is this a VC that's okay backing founders and a pitch deck? Are they that early? Right. So you need to do your own research of like, what are the VCs I need to reach out to? What sectors? I get pitch. I'm a gaming and interactive media fund. People send me pitches about like agri tech and fintech, which tells me, okay, people are not doing their research. Like, why would you reach out with that sort of deal to me, right? And also, does their check size match what you're looking for? Like, if you're looking for a 200K, 200K kind of investment, don't reach out to a fund whose minimum check size is 1 million. You're probably too early for them, right? So I think some amount of research, some amount of just talking to people, some talking to other founders who raise money is important to kind of figure out how do I curate my outreach. Because if you will reach out to people that um and that's my point four, but you'll end up reaching out to people who are not right for you, just structurally not right for you, nothing against you or the business, and they'll say no and you'll get dejected, right? So that, and your reach outs have to be curated, right? If you're a gaming fund and you're reaching out to Lumikai, uh, have a curated reach out that, hey, by the way, I really care about raising money from this VC, so let me curate a reach out. Like, let me personally reach out. Let me reach out on LinkedIn. Let me, talk about, hey, by the way, I really like what you've done with this previous investment or that previous investment. I think what we're doing could interest you. Um, don't do bulk emails. I can see right through it when I know that it's a bulk email, right? People have gotten my name wrong, people have reached out to me saying hi elevation capital, right? Like, so I think all of that is just going to reduce your chances of raising money. I think another underrated aspect is our corporate matters in order, right? I see a lot of deals take time or even fall through because corporate matters are not in order. Like, you're not incorporated, incorporation is taking too long. Shareholding is not clear. There's fights going on between the founders on who owns how much. ESOPs are not done, right? All of that. A VC, early stage VC will help you through all this, but like you need to know that, okay, you're also running a business. And running a business in India is hard. Right. So, there's all of these compliances, secretarial items, all of that. Are you ready for it? Do you have an auditor? Do you have a company secretary person? Do you have a lawyer who understands what it is like to raise money at the early stage? Don't go get a lawyer who does M&A because there's going to be a big difference in what the VC wants and what he's saying, and like it'll become messy, right? So pick a venture lawyer, pick a company secretary, be prepared for all of that, right? Be prepared for those expenses also. And I'd say be prepared for rejection. And look, maybe look at me and say, okay, never built a company, so don't sort of understand it. Like, I've raised for the fund, right? We've reached out to probably 500 leads and ended up raising across two funds, which is 4 years, raising from like 20 or 21 people, right? So seen a lot of rejection, and it can get dejecting, right? You probably have to go through 50, 60 pitches, a lot of requests, a lot of like random calls. You have to go through all of that before you land an investor. Some VCs will be nice to you, some won't. Kind of that's just a part of the game. But if you truly believe in kind of what you do, this grind shouldn't kind of. I would encourage the grind shouldn't dishearten you, right? And I've known guys who've stayed at it. Like we looked at them in 2020 or 2021, stayed at it, because we passed at it, but passed on them, stayed at it, then eventually ended up raising money from us because you're like, oh no, I will go and execute what you told me to, and we were like, hey, pretty good, fair enough. Let's do this, right? So, and usually a VC's no is usually a not now, right? VC very rarely categorically rejects businesses because we're afraid that we'll miss out, right? So a VC's no is always not now. So every time a VC says no, you have to keep them updated. That okay, by the way, this is where I'm at, this is who I've raised from, and all of that, right? So I think these are some sanity checks before you start fundraising to think about. I think some certain must-haves before you start pitching to when you go to pitch to VCs. One is I call it a pitch deck. It could be a deck, it could be a memo, it could be a write-up, it could be something, but it should cover these main aspects, right? Because I it depends on VC to VC, but I gain a lot of insight and knowledge and judgment on the business by just looking at the pitch deck, as opposed to then I get into the call with the founder and then ask questions I need to clarify. But I usually come into meetings having read the pitch deck, right? So details on founding team, past experiences, past. I've seen decks where the founding team, there's no slide on the founding team, like it you guys, the founding team is the heart and soul of the business. They're going to run it, right? So that has to be front and center. Oh, by the way, this is who we are, right? This is why we're building in this space. A clear understanding of what is the business. So you usually have 30 or 45 seconds to grab an investor's time when they're looking at a pitch deck, because an investor is looking at 100 pitch decks a day. If you nail details on founding team and what is the business in a catchy way, where I look at it and go, oh, by the way, this is cool, I want to read on. That is the game, right? It could be, like I'm trying to think of like, okay, Studio Seraph, for example, don't come from game development background, right? But the business it was a very clear proposition. Like Indians are maturing in their gameplay choices, and Indians are also at the same time want to see more of their culture. So I'm building mid-core games for Indian audiences, which tells me very clearly, okay, this is very clear in terms of what they want to do. And then you move to the founding team. Okay, cool. There is some expertise here. Okay, by the way, they built a prototype, and then I want to read on further and further, right? So nailing these two things, at least in my opinion, will matter a lot. Then thesis, right? What is the insight? Like, okay, I've seen this market, I see this particular white space in the market. So what's my insight? I went and spoke to 60 people in this sector and they told me like this is missing. So I think I should build for this. So what is your thesis? Like what's the thesis on which this is being built? What is the market? Is it a new market or an existing one? How is it growing? Your analysis of market dynamics. Product metrics, if available, if you have a product out, give data points on metrics. Be upfront, be clear, be straight about this is where I'm at. If a metric doesn't look good, a VC will ask you, right? So you don't need to hide any metrics. Competitive dynamics goes back to the market, like who else in the market were you competing against. Very important to have a roadmap. Very important to like be clear to a VC saying, listen, in the next 12 months, I want to be here. In the next 24 months, I want to be here. These are the metrics I will track. This is my North Star internally. Like this is where I'm trying to reach. Uh, Details on funding, past rounds, current cap table. What are you looking for right now? It comes to my second point. Like I've come across so many pitches where a founder himself doesn't know kitna paisa uthana hai, right? Like you need to know how much you want to raise. There's a rationale behind how much you're looking to raise. People have come to me saying, I want $50,000 for the next 6 months, and I say, okay, cool, but my minimum check size is 500K, and they go, oh, by the way, 500K will also do, right? But your initial projection was for 50K. How is it 10x, right? In one conversation. So just my rule of thumb is when you're budgeting for how much to raise, budget for 18 to 24 months of runway. And budget for like 4 or 5 months of it takes 4 or 5 months to close a fundraise. So budget for that, right? So we're looking at between 18 to 30 months of runway that you should have. The moment you tell VCs, by the way, I'm raising just for the next 6 months and I'll go raise my next round, it's a big red flag for me. Because okay, if in 6 months I'll know whether you live or die, which doesn't inspire a lot of confidence, right? So, and there's some FAQs, cap table, who are existing investors, funding history that'll come up, just incorporation information will come up, just what your where you incorporated, who's your lawyer, all of that. Um, VCs will usually ask for an MIS, which is like a monthly information statement for the last 12 months if you have a live product. And if a link to the product, like a best way to get a VC to just send them the product, like, hey, try this out. And I think that's what at least gets me very interested when I'm trying a new game, I'm trying a product, and I go, okay, by the way, this is super cool, right? So I think this is something that you should consider. Just a quick kind of pointer on so time check. Yeah, we got yeah. A quick sort of pointer on what the process with the VC will usually look like. I want to caveat this upfront with like this will vary a lot basis investor, but I'm just telling you a quick just a broad framework of how things will work. So your first call usually will happen with an analyst or an associate, where any good analyst or associate would have read your deck before, right? And they would come prepared with some questions and they'll cover the basics of intro to the founding team, what is the value proposition, what is the thesis. They will cover deal dynamics of, okay, how much you're raising, do you have commits from anyone else, what's the valuation. All of that will kind of happen usually will happen in the first call. Just a quick point on analysts and associates. I know they get a lot of shit in the VC industry. Um, See, it depends from fund to fund. Like we are a fund where an analyst or an intern could source a deal and it could go through, right? Because they have conviction on it. So everyone in our team has decision-making ability to say that, okay, by the way, I really want to champion this internally. Larger funds usually don't have this. So in larger funds, it's maybe sometimes becomes a waste of time around like, by the way, I spoke to an analyst associate and it turned out to be nothing. Um, but in smaller funds, usually they have a lot more say and a lot more ability, right? So maybe team size also kind of matters there when you're doing your research on the fund. So after the first call, usually they'll go back and say, by the way, this is very interesting. And it moves to a deep dive. This will involve multiple calls where we sit down. Like I personally do a 1.5, 2 hour call where I just sit down and like run through a bunch of questions that I have in my mind, and typically happens in person. We will also go back and do more research. We'll do background work, talk to experts, talk to customers, review your MISs, and that's sort of the deep dive. Once the deep dive is clear, usually move on to a partner level call. The partner is the highest kind of decision making entity in a VC fund. They run the business, so they will do a call. In our case, the partner call is more around like understanding the founders a bit better because they have judgment on people. That is a lot more informed than sort of the junior team, just virtue of experience. So it's largely around that team culture. How do you do all those things? It becomes the partner level meeting. And then the last is usually an IC. The investment committee is kind of this committee of people which will include the partners, but also a couple of independent people who are not part of the fund. And it acts serves as a check and balance, right? So you pitch to the IC or the deal team from the VC fund will pitch to the IC, and the IC is the final one that takes the call through a majority vote or whatever that is. So that's essentially the diligence process. And then the investment process is if you've passed all of that, congratulations, you will get a term sheet. A term sheet is a non-binding legal document. A non-binding as in you can't go to court and it's not a you can't go to court and sue someone on it over it. It's not on stamp paper and all of that, so it doesn't really work in it. But it's kind of like a gentleman's agreement, a handshake. Like, by the way, this is what we've agreed to. These are the key commercial and legal terms of the deal. It will lock in your round size. It will lock in how much the investor's putting in, how much the co-investor's putting in, what is the valuation. It will include all the key commercial rights that an investor would want in a deal. This could be, they'll want the right to exit in 5, 6 years. They will want the right to maybe invest in your next round at a certain kind of price or to maintain their equity stake. They will want information rights. So like I get the right to get an MIS from you every month and all of that. So a very standard kind of set of rights. We usually tell founder. See, most VC term sheets are very standard. Um, Usually it's not worth negotiating a lot over the term sheet. Right, you'll piss off a VC, right? Because like this is standard. I cannot do without this. This is the same answer you'll get over and over again from a VC. Everyone will get frustrated. Things worth kind of fighting over are vesting. If you've been in the business long enough, like you want certain amount of shares of your shares to vest up front, maybe worth fighting over valuation a little bit, but like standard terms like information rights and uh exclusivity and validity of the term sheet, like it's honestly not worth it. You're getting money, it's just take it and go. Uh, Once a term sheet's signed, there's usually, if your business has been running for long enough, there'll be financial legal due diligence. So they'll bring in like a Deloitte, they'll bring in a legal team to look at all your materials and say, okay, it's kosher, there's no tax and liability and all that, right? And then you move to definitive documentation, which is essentially a subscription agreement, which is an SSA, and a shareholder agreement, which is an SHA. These are legally binding. So all of the things you agreed in a term sheet are kind of put in long form and put in the SSA and SHA. And this is a legally binding document essentially that you sign. And then once all of this is done, there's some things around like secretarial stuff, some RBI stuff that you do, which obviously if you have a legal team will walk you through it, and then we wire, right? So this is the entire process. Um, the timeline on this varies again from fund to fund. There are deals that have taken 4 or 5 months. There are deals that take just a month. It really matters. But your goal should be to, get to an IC meeting in like 3 weeks if possible, right? Because there's no point keeping it open for that long because you'll be in the market for long and it kind of becomes a problem. This piece, which is the investment process, is just kind of procedural, so it can take time, it can not take time. But this is where you should kind of optimize for speed, right? This is where you should keep following up with your investor, asking where you're at, how can I help, what is the next step, like be a little wary of investors sort of taking you around over and over, right? This is something you should try to close in 3 weeks or 4 weeks, right? But this can sometimes take time, not take time. Term sheet usually will come very very quickly after an IC meeting. It'll get done in a week, but the rest of the things can take probably a month and a half, 2 months, right? So also, if you're in immediate need of cash, you should sort of consider this kind of timelines, right? And just a couple of things I want to close on is usually why does a VC usually pass? So one thing is a VC, some VCs will give you, so if it's a first call and they pass you on a first call, a VC is probably not going to um, give you a detailed reason. But if they've gone to calls 2, 3, they've done a deep dive with you, maybe they've done all the way to a partner call and IC call, then if they've taken that much time, a good VC should give you a reasoning as to why they've passed. Um, but and if it, and you are also, I think, maybe entitled a little bit if you spend 4 weeks with a VC and a VC passes to ask for feedback, right? Usually what I do is if I've spent 3 or 4 weeks with the business and done multiple calls and it's gone to IC, I usually just call up the founder and say, by the way, this is why we passed. Uh, if it's the first call, you will usually get a very frustrating, hey, by the way, doesn't fit our thesis, or decided to go in a different direction, or couldn't build in what internal conviction and so on and so forth. Usually the reasons I've kind of majority reasons I've listed here, founding team. Of course, the VC is not going to come and tell you, by the way, I don't believe in you as a founding team. Never, not going to happen. But usually they feel that, okay, I don't think this is the right founding team. I don't think the team has the right skill set to take on this market, or there's okay, I don't have conviction on this guy's competence to really build this out. Or something's missing in the 5 Cs. Like you've gone and done a soft ref checks and figured out, oh, by the way, this guy's so, messed up in his previous thing or got fired or something. There's some adverse information that has been found out, right? Which is why there's a past market too small for a venture scale outcome, which is what I said. Like, are you a 30x, 50x kind of business? Or there's too many competitors, we don't know how you're going to compete, or there's very large incumbents, like in free to play casual today. I keep going back to the example, but you've got Peak and you've got King who've got a lot of money to do in the match three space, right? So how do you compete with them, right? So large incumbents that we feel will be difficult to get disrupted. Then there's the business, the idea, the thesis. There's no clear moat or defensibility. The thesis doesn't seem realistic for this goes back to a timing thing. Like, well, probably not the right time. it's too early for a VC fund. So there could be a fund who does seed and Series A, and they could decide, by the way, I'd rather wait till Series A to see how this company evolves before I make an investment. So maybe it's too early for me right now. So I don't want to do it right now. Or if you have metrics and you show those metrics and a VC thinks, okay, by the way, I don't think these are up to par, and I don't see a path to how these metrics become better. That's one reason why people pass. Deal dynamics also matter. Round size is too small or too big. Okay, you come to me at a 10 million round size. I'm looking for a 10% stake. You're right. So it'll, I would say, okay, not worth me spending time because it's too big a deal for me. Or it's too small. You're looking for a 200K check. It's not worth me allocating resources and lawyers and all of that for a 200K check. I'd rather wait till you raise your next round, which should be 1.5 million, where it makes more sense for me, right? Just as an example of how things look. Um, and then others who regulatory challenges, okay, like, okay, I think this is a big, like, SEBI will come and clamp down on this tomorrow, or which is the case with most RMG businesses today, is we don't know where GST goes and how that things happen, right? So that, or there's limits on VC's thesis. Okay, they've already got a portfolio company that does something similar to what you do, so okay, it doesn't make sense, right? Or there's a restriction on, hey, you can't do RMG, uh, right? So in the strategy only it says no RMG, so that kind of is the other restriction. So what are the nuances for interactive and gaming companies? The couple of things, right? Is VC the right source of financing for you? Is a big question that I get, right? As I go back to the point of, like, do you feel that you'll be able to manage an investor, board member, doing audit, doing monthly reporting? Is that something you're okay with? Then yes. If you are at a very, very early stage, you need 50K, 100K, that sort of check size just to get you started. A VC is probably not the right route for you. Look for angels, look for grants, look at those things. And certain businesses are not VC businesses, like service, guys who do game services. It's a great lifestyle business, right? Like, I love these businesses in that founder owns 100%. They're earning decent amount of money, decent dividends going back home. Um, but this is not a business that's going to 100x because it's services, right? It's because you can only service so many clients at a time without really increasing your headcount. So you don't really have the leverage to grow this to 100 times business. So they're good bootstrap businesses, right? Like, you own all of the business, you'll make a lot of money, right? If you sell it, all of the proceeds will come to you, right? So I think that's one. So is VC the right sort of financing for you? That's something else. Picking the right VC, interactive media and gaming are very different to other consumer tech businesses. Most VC lenses of, hey, is this solving a problem? Break down, because you're not solving a problem, you're providing entertainment for the most part. So also, most businesses, you'll be front loading dev costs, and eventually revenue will come at some point in time later, but will come at a very fast pace, which is the case with most gaming companies, most interactive companies, right? Most platforms. So our VCs, okay, I've had horror stories of, VCs who are unfamiliar with the space investing in a gaming company and asking on day one when's revenue going to come, and the prototype also wasn't built, right? So it's something to think about. You'd be better off without a VC than actually having a VC who doesn't understand the business, in my opinion. And you should ideally know more about the market than your VC, right? If a VC knows more about the market than you do, then there's usually a flag, right? So I go into a call thinking, okay, can I learn a new insight that this founder's given me? And that, I think, bodes really well. Specifically for gaming companies, and the gaming companies building studios and games, developing games. A VC is going to back a studio and not a single project. Be very sort of clear about that. A VC derives value from the sale of the studio, not from the revenue of that single title, right? So if you're going to be a single title studio and you're looking for revenue just from and you're looking at just this, you want to finance that one game, that's project financing. VCs will not do that. Look for grants, look for publishers instead. A publisher will not own equity in you. They won't really care. They just want their money back from the business, right? That's all. So you're much better suited for that. Also, be prepared to show some execution capability of some past experience or through a prototype. I think that really. If you're building a platform business, large user base, etc., be prepared that they will require a lot of capital. So be prepared to kind of raise a lot of money in front of this fundraising treadmill. And lastly, just my read of the industry today and what people are shying away from. Not that they won't do it if they see an exceptional team, an exceptional idea, exceptional product, but what I've seen people shy away from both in India and globally is Web3 crypto. Is something that people are hardly touching. You'll see probably one or two deals maybe happen. Real money gaming also is in India specifically is kind of a world which people are not really touching because of the whole GST burden. AAA, I think the word AAA is very loosely thrown around in this industry, but what I mean is high production cost, high development, long development cycles. It's not a VC business, it's more so a publisher business. And then I think esports also has kind of has taken a bit of a hit. I think the next wave of innovation will come in esports at some point, and I think funding will rise up again. But these are kind of the four in my read of the market, and something for you guys to consider if you're thinking about it, that okay, these are probably harder than most to raise money for. So yeah, that was a kind of a quick sort of sojourn into how a VC thinks, what you should be prepared for, what you should not do, what you should do if you're going to raise money from a VC fund. So that was me. Very very happy to take questions now. Later you can ping me on this email ID here as well if you have any questions, and we can chat.